Welcome to Taking Stock for the week ending the 11th of February 2022, where we stream all things share market. Joining me today is our Managing Director and Chief Investment Officer, Tim Lincoln. Thanks for coming today, Tim, and I hope you are well.
Yeah, I'm well now, Kien. Had a bit of a bout of COVID with the family up on our holiday in Queensland for the last few weeks, but coming good now. And I hope you're well too, and your family are well, Kien. And you had a nice break, and hoping that all of our members and investors are also happy and well, also and safe in this environment. But it certainly has been an unpredictable and crazy market over the last few weeks, hasn't it, Kien? Especially through the month of January, with quality and growth stocks sold off earlier in January in favour of speculative stocks, value stocks, and larger cap defensive. So a real rotation away from the high quality growth stocks. Concerns about inflation and rising interest rates remain the driver of this volatility. And to help our members navigate through the current bout of volatility, I recently sent an important message that is available within Stock Doctor from the Resource Centre. But at the moment, Kien, we need to really remain vigilant to our individual investment philosophies. And for example, that might be your tolerance to volatility, your stage of life, whether you're a growth or income focused investor, and maintain the faith that quality companies with strong financial health and solid cash flows will prevail in the end. Despite expectations for rising interest rates this year, on the back of what we believe to be unavoidable and temporary inflationary pressures, interest rates are expected to remain low historically, and this is expected to drive equity markets for still many years to come, Kien.
Yeah, that's right, Tim. And we have to see that some of these opportunities are emerging, especially during the reporting season with our star growth and star income stocks reporting a decent set of numbers as well. And yes, there have been heightened active risks around supply chain disruptions, rising labour and shipping costs due to COVID. But those businesses with very strong balance sheets and a healthy profit margin have shown that they are able to navigate comfortably in the current environment. And take, for instance, star growth stock James Hardie. Despite having recently sacked their CEO and also reporting rising energy costs with labour and material shortages, the company was able to lift its full-year guidance by about 1.6%. And they were able to do this by lifting prices by 5% in January and also implementing a strategy by moving towards the direct-to-consumer channel where there has been strong renovation activity, Tim.
Yeah, it's funny, isn't it, Kien? It's all of these increasing prices, and James Hardie's a good example of that, where companies, large companies especially, are putting their prices up, which obviously drives the inflationary pressure. But overall, despite the temporary inflationary pressures, earnings revisions have continued to move higher, as shown in the chart on screen, which compares the All Ordinaries Index to its 12-month forward earnings trend. In fact, over the last 3 months, earnings expectations for the market have been upgraded to close to 10%, which is just incredible. Meanwhile, the economy has continued to recover from COVID, with COVID-related hospitalisations now falling across Australia and many other countries, Kien.
Yeah, Tim, hence the reason to be optimistic for the year ahead. So far, financial year 22 earnings growth expectations for the market is expected to come in at 14%, and that's driven by most sectors, including the banks, the resources, industrials, as we can see from the chart on screen. Our star growth stocks, though, are expected to fare even better, with earnings growth expected to exceed 20% this year. But we'll be keeping a close eye on the numbers within the cyclical resources sector, where growth is expected to decline considerably in financial year 23. Let's now turn our attention to some of our star stock highlights for the week. Now, over the week, we had the banks. They released all their updates, the 4 major banks here. And the key takeaway, the banks are performing quite well despite higher funding costs and competitive pressures on their loans and deposits, leading to pressure on their net interest margins. Now, which is the difference between a bank's rates on its loans and deposits?
Yeah, fascinating, Kien. But why does this matter so much? And should income investors be worried about the potential for future dividend reductions, especially given that most banks are expected to lift their payout ratio for the coming period.
Yeah, we saw that the banks were lifting up their payout ratios as well. But this matters because if you think about net interest income, that is a core part of the bank's profitability. But we don't think the pressure on net interest margins will impact the sustainability of a bank's dividend, mainly because the reasons are that the banks are in a strong capital position. Secondly, bad debts are falling on the back of the stronger economic environment and also higher employment rates. And lastly, the potential for interest rate rises this year could put less pressure on interest rate margins because banks are able to increase their loan rates well above cash rates.
Yeah, really interesting, Kien. Fascinating stuff. And amongst the four majors, Westpac currently has the highest gross dividend yield, which includes franking credits, at 7.7%. So a wonderful yield there, grossed up. While the CBA is on the modest gross dividend yield of 5.4%. So Westpac certainly the standout. The lower yield on CBA reflects the quality of its loan book and market leading position. Meanwhile, Macquarie Group has a modest dividend yield of 3.7%, but it is more a growth story and hence why it's both a growth stock and also an income star stock, with its earnings tied to global commodities, asset management, and annuity style infrastructure assets. The bank segment only represents 16% of its total revenue. So very much a diverse company is Macquarie.
Yes, Tim, and this week we farewelled furniture retailer Nick Scali from our Star Stock universe because its return on equity has declined by more than our allowance. And even though they had strong customer orders, that was offset by soaring shipping costs and lockdown restrictions from countries such as Vietnam. And this is likely going to be a drag on their second half profits, with earnings growth expected to decline this year. And from an income perspective, the expected significant decline in free cash flow from 122 cents per share to 59 cents per share due to the acquisition of the plush sofas means that we are not confident on the forecast dividend.
Yeah, and Kien, from a Lincoln Australian Income Fund perspective, we've noted that you've removed Nick Scali as a star income stock as well. So tactically, what are we doing with the stock right now? Because the financial health is still there, and because the financials overall still look pretty good, they're just coming off a really high base in a lot of the areas that you've mentioned. However, there is going to be pressure on the yield going forward. But because we're fairly comfortable with the stock, we're just going to wait until they go ex-dividend so we receive that full distribution, but we will look to exit the stock as soon as it does go ex-dividend.
Yeah, and they go ex-dividend on the 4th of March.
Yeah.
Also, in the income space, AusNet Services, they've been suspended from trading following its takeover by Brookfield Asset Management, and shareholders will be paid on Wednesday, the 16th of February, at a price of around $2.60 per share. Now, with the reporting season still in full swing, let's turn our attention to the corporate calendar. We've got JB Hi-Fi kicking the week off, followed by Ansell and BHP on Tuesday. On Wednesday, we have Breville Group, CSL, Netwealth, Fortescue, and Pro Medicus closely behind on Thursday. Codan, Charter Hall, Social Infrastructure, South 32, Telstra, and West Farmers. Lastly, on Friday, we have MyState and Rural Funds confirmed. And for trend-sensitive investors, Stock Doctor has the SD Max, which is the Stock Doctor moving average crossover, or the SD30 TSR, which is the 30% stop loss or gains from its highs or lows. For those who are highly trend-sensitive investors, we have bearish SD Max signals. They were triggered on Adairs, Breville Group, Brambles, CSR, Gold Road Resources, Macquarie Group, and Netwealth. Not surprising given the volatility. But meanwhile, Rio Tinto triggered an entry on the SD30 TSR, and that's for those who are moderately trend sensitive. In Under the Microscope this week, we take a look at borderline star growth stock, REA Group, which has been our longest serving growth stock and has done exceptionally well for our investors since we began covering the stock in August 2005 at a share price of $2.27. Just to remind investors, REA Group is Australia's leading online property platform with an expanding global footprint. The company reported a 30% rise in earnings and was able to maintain its return on equity and net profit margins at 32%. And the key driver of growth was due to the gradual removal of COVID restrictions and a recovery in national listings, with Melbourne up 43% and Sydney up 14% versus the prior period.
Yeah, what a great business, Kien. And yeah, our long-term members have held REA in their growth style portfolio for a long time now. Obviously, it's added a lot of alpha to their overall portfolio. So yes, a wonderful Aussie success story, REA Group, that's for sure. But the outlook, Kien, I've noted, is expected to be weighed down by higher costs going forward. Is this an active risk that you're considering and our members should also consider?
Yes, Tim, and we've mentioned it in the strategic comments, but although it's not too high, the company is forecast to generate in excess of 20% earnings growth this year on the back of the integration of the Mortgage Choice acquisition and also the strong growth across its international markets like India and the US. Meanwhile, the profit margins should continue to be supported by the strong take-up of its premium listing products, Tim.
And Kien, I've also noted that earnings revisions on the stock certainly look positive following its latest result, and that can be seen under the new feature of earnings per share growth revisions under Golden Rule 3. So nice little feature, and that particular feature will be able to be plotted on the graph under Golden Rule 4 within our next release of Stock Doctor. However, many investors may be wondering whether rising interest rates, Kien, may impact the property market and this stock in the not too distant future.
Yeah, Tim, but we need to remember that REA's earnings are driven by its listing volumes rather than the property prices. However, despite the potential rise in interest rates, the CEO did mention that interest rates should remain at historical low levels, Tim, and future buying and selling activity should continue to be supported by a recovery in migration, for instance, easy access to credit that's continuing, and also the strong employment rates as well. Hence, we believe any further price weakness in this stock could represent opportunity for investors.
Yeah, great to see the leadership of REA also agree with our view on interest rates, Kien, and that they will or should remain low for the foreseeable future. So wonderful for equity markets and also the property market, Kien. However, under Golden Rule 4, the share price is displaying a bearish trend on SD Max. So we remind members who are highly trend sensitive and who follow this indicator to remain out of the stock until a bullish trend is triggered.
Stock Doctor provides a full set of tools to help you during the reporting season. So the question this week is, how can Stock Doctor help me monitor my stocks over the course of the reporting season? Firstly, there is the corporate calendar to help you keep track of your announcements. Here you can select from a group of stocks such as those from the ASX 300 or those in your portfolio and watch lists. Not only does the corporate calendar contain the date of company results, but it also has the AGM dates and ex-dividend and payment dates as well. And for those income investors, you can also click on pending dividends to see what stocks are going ex-dividend in the coming days. Also, under Tools in the Alert Manager, you can set up a new or multiple alerts so that the system can remind you of any upcoming announcements, any analyst reports, star stock changes, or technical triggers.
Yeah, Kien, the great thing about Stock Doctor and really why we built Stock Doctor and designed Stock Doctor the way it is for members to be able to really make dynamic decisions during reporting season, because it's critical that we do that in order to stay well on top of our portfolios, weed out the stocks that are no longer elite businesses relative to our investment philosophies and criteria that we seek, and also make good informed decisions and include new stocks in. But we've got to do that dynamically, and Stock Doctor provides all of the tools to be able to do that with a high element of control. But also there's the wonderful feature being the watch list. And the great thing about the watch list is it provides members with all of the beautiful fields and columns that they can sort their stocks on during reporting season to highlight the stocks that they need to focus on in that timely, dynamic fashion. For instance, if you are a trend-sensitive investor, you can sort the columns in under SD Max or SD30 TSR to identify the stocks that have triggered bearish signals during reporting season to exit those. Or if you're an income style investor, you may want to sort the columns by ex-dividend date or pending ex-dividend date to identify where you need to be making decisions around dividends, plus all of the other fields there from a fundamental perspective that'll allow you to make those dynamic decisions. But there's also other features to keep track of all of the star stock updates. You can go to the research tab and click on the view all button under the latest star stock updates. Here you can filter for announcements and star stock changes within the Stock Doctor universe or your own portfolio, which is terrific. Again, it just allows for total efficiency during this critical time of year. And of course, there's the daily digest email where we provide you with a list of star stock updates that you and your team, Kien, have analysed during the day. So a plethora of useful tools there to help you stay in total control during this critical period.
Yeah, Tim, the information that's coming out is quite dynamic, so you need to be on top of everything. But again, thanks, Tim, for your taking the time out to share your insights today.
Yeah, it's a crazy market, Kien, as we said in my piece that we sent to members a couple of weeks ago. It's a crazy market. It's totally unpredictable at the moment, especially from a growth investor's perspective. Income investors are holding up quite well. It's just those beautiful quality growth stories are, they're under a bit of pressure at the moment. So we just got to hang in there and know that this is purely a cycle being driven by inflationary pressures, which should cap out. Interest rates, yeah, they'll rise, but they'll remain historically low for years to come. And growth, quality growth stories will have their time in the sun again. It's just a little period of a cyclical period that we're going through right now that we've seen before.
And many of these quality growth stocks are reporting solid results, Tim. So to remind investors, reporting season is usually a time when our star portfolios have higher than usual turnover. But note that some of the transitions between star growth and borderline star growth stocks may need to be postponed at the end of the reporting season once all the results come in and are assessed relative to each other using our star growth stock quant model. To summarize, the reporting season so far has been positive, and despite concerns about inflationary cost pressures, the trend in corporate earnings remains up. Currently, earnings growth for the market this year is expected to be 14%. Hence, embrace the volatility and use the reporting season to position your portfolio in those oversold quality stocks. Take care. Have a happy, healthy, and prosperous week, everyone.